Good morning, dear students. Back again with another illustration, and I would like to congratulate the whole class because you are doing wonderful work, children. And accounts is all about practicing, and I'm glad maximum 80% of the class is submitting the work on time. Rest of the class, I request you to please be online. I know there are some problems you are facing due to some network issue or some technical issue, but try your 100% to be online because I miss you all, and I would like to see you in the class very soon. So try your best, children. And today I'll be explaining illustration number 13. In case if you have any doubt regarding this illustration, just get back to me. You know the ways. I don't have to tell you every time how to reach your madam. So let's begin with the illustration. This is your illustration number 13, dear students. Have a look. Kiran Enterprises purchased a printing machinery for 80,000 on 1st July 2011 and spent rupees 10,000 on its transport and installation expenses. So original cost of the first machinery which they bought is 80,000 plus 10,000, that is 90,000. The machinery which was purchased on 1st July 2011. The enterprise has also purchased another machine for 70,000 on 1st January 2013. Depreciation is charged at the rate of 20% on reducing balance method, and the books are closed on 31st March every year. Prepare machinery account for 3 years. So now let us write what exactly is answered in the question in the illustration. Just have a look. This is illustration number 13. We are given on 1st of July 2011. Printing machine is bought for 80,000, and we have spent some 10,000 on its transportation and installation expenses. So original cost of this machinery is 90,000. Then in 2013, that is on 1st January 2013, another machinery is bought which is for 70,000. The rate of depreciation given is 20%. The method we are asked to do is reducing balance method, and the accounting year is from April to March. April of the previous year to the March of next year. Okay, so here you will have to be very careful with these dates, dear students. Generally what happens when we take from Jan to December the accounting period, you get the same year. For example, if we take 2011, January 2011 to December 2011. But here the accounting period given is from April to March. That is 1st of April of 2011 to the 31st March of 2012. So when you put dates over here, you need to be really careful, and accordingly you will be calculating the number of months that particular machinery has been used in the organization. So let us begin with the sum. We are going to write in the books of Kiran Enterprises. We are preparing printing machinery account on reducing balance method. Then we'll put a debit and credit. Okay, and here I have already drawn the format for you. We have date, particulars, journal folio and amount on the debit side. Then we have date, particulars, journal folio and amount on the credit side. Now let us see what has happened during the year 2011. We are asked to prepare the printing machinery account, dear students, for 3 years. So we will be making for 2011 to 2012, 2012 to 2013 and 2013 April to 2014 March. Okay, so here we go. 2011, when did we buy the machinery? On 1st of July. So we paid through check to bank account. Once we gave 80,000, and the second time we gave 10,000 towards transportation and installation. Same date again on 1st July to bank account. But the second time when you are writing bank, write very clearly for what you have spent that amount. So it's going to be transport and installation expenses. Okay, so with that we close towards the debit side. All right, just go to the credit side. 2011, by end of the year we are supposed to close the account. So here it is 1st April 2011, but there has been no transaction, no machinery was bought, or there was any old machinery which was used in 2010 so that we could bring the balance down here. So actual function has started during the month of July. So if we take from July, so here we have 31st March 2012. So here the year will change, children. On top you will have to write 2012 because this is not 2011. It has started in April. We are running it on the next year, 2012 March. So we are charging depreciation here by depreciation account. Okay, so what is the value of the asset? 90,000. Just have a look here. 90,000 into the rate of depreciation given is 20%. Cancel the zeros. So we have 18,000 as the depreciation for the first year, that is 2011 April to 2012 March. So this is the accounting year, dear students. But if you see carefully, we bought the machinery in the month of July. It means the machine was used during the month of July, August, September, October, November, December, January, February, March 2012. So number of months we have here is 1, 2, 3, 4, 5, 6, 7, 8, 9. So we have used the machinery for 9 months only. So how can we take 12 months depreciation amount? We'll have to calculate it only for 9 months. So to get it for 9 months, you just multiply it with number of months in a year and the required months, or you say the machinery, the number of months the machinery has been used in the organization. So when we multiply it, 3 3s are 9, 3 4s are 12, then here we have 4 1s are 4, then 4 4s are 16, 4 5s are 20. Now 3 into 4,500, 12, 13,500 is the depreciation for 9 months. So that very same amount we'll write here, and but see to it that in brackets very clearly you mention it for how many months you have calculated. That's going to be 13,500. Now just total on both the sides. We have 90,000. Credit side we have a difference amount that will go under the heading of by balance, C by D. The value of the asset by end of the accounting period, again 31st March 2012. So the difference amount will get 76,500. The side also just put the total 90,000. So this is the book value of the asset, children, by end of the year, accounting year, that is on March 2012. Now let us make it for next year, that is going to be 2012, 1st of April. The value of the asset was, you'll write to balance, B by D, brought down how much? 76,500. Now we'll have to calculate this 20% on this 76,500. That is going to be on 31st March of the next year, that is 2013. Okay, so we will write by depreciation here. But during 2013 we bought another machinery also, children. So we will write that also. That was bought on 1st of Jan. 1st of Jan we bought a machinery. So we will write to bank account. For how much did we buy? We bought it for 70,000. So if you see carefully, the accounting year is from 1st of April till 31st of March the next year. Here we bought it during the year 2013 Jan. So here we need to mention 2013 also, children, because if you see from April till March you have Jan in between. So because this January belongs to 2013, so you'll have to show that as well on the top, that during 2013 it was bought. So if we bought it on 1st of Jan, it means this machinery was used only for Jan, Feb and March 31st. That is only for 3 months. So on second machinery Both the machines are used in the organization. The first machine is completely used for 12 months. So we charge depreciation for the first machinery on the book value of it at that time. And second machinery, we have 70,000. We'll be charging depreciation for only 3 months. So book value of the first machinery is 76,500, children. So if you can take 76,500 and you calculate 20% on this, this is what is called as a reducing balance method. The book value at that time in the value of the asset at the initial of the year, we'll take, now just see, multiply it with 2, 0, 10, 12, plus 1, 3, it is 15,300. Okay. So for the first machinery, we will write depreciation account. For the first machinery, we have got 15,300 plus the second machinery is also bought, dear students, and we used it only for 3 months. So we will calculate it for 3 months only. Second machine's amount is 70,000. 20% is the rate of depreciation, and we are calculating it for 3 months. So let us have a look. 0 zeros cancelled. 2 ones are, 2 6 are, 3 ones are, 3 2s are, 2 ones are, and 2 3s are 6, 2 5. So it is 3,500. So when you are writing 3,500, you just mention very clearly that this 3,500 is for 3 months. Okay. So this is the depreciation on both the assets. When we add them, we'll get an amount of 18,800. Just show the totals on both the sides. We have 1,46,500. The same will be transferred this side, 1,46,500. By end of the year, let us see the balance of both the machineries, book value of both the machineries after their value has decreased. Again on 31st March 2013, when we minus 18,800 from 1,46,500, children, we'll be left with 1,27,700. So this is the book value of the asset, both the assets. Now here we have 2013 March we have ended there. After March, April comes. So at that time, what is the balance? Opening book value of both the assets. We will bring the balance down, that is 1,27,700. Both the machines were completely used during this year. Closing year is 31st of March 2014 by depreciation account. If you want to show separately each machinery, you can show, children, or unless you can directly take the amount, like we have 1,27,700. You just directly take 20% on that, because we don't have any other information as such of purchase and sale. So we will go like this. 2 7s are 14, 4 1 14, 2 2s are 4 5, and 2 1s are 2. So how much is the depreciation? 25,540. So we'll write depreciation account 25,540. If you deduct this reduced value from the value of the asset, you will get an amount of 1,02,160. 1,02,160. We'll show the totals here. So this goes as balance C by D. We'll show the total on both the sides. That is 1,27,700. The same we'll write this side also, 1,27,700. So the next year, that is 2014 April, we have the balance, the value of both the assets as 1,02,160. We'll just show that and we'll leave this machinery account here itself. But also remember, you'll have to show the working notes also, how you have done. And though I have shown you in the rough, but this is how you'll be showing the working notes, children. I'll show it in your textbook. It will be more clear to you. And do remember, only illustrations I'll explain. All the textual exercises you'll be doing, try to be one step ahead than me, so that it will be more clear to you and you can clear your doubts in the next question when actual explanation is going on. I understand, dear students, online learning is not easy, but trust me, online teaching is also not easy. I miss you all. So have a look at the working notes in the textbook. Just have a look how you'll have to show. You'll just write the heading as calculation of amount of depreciation. Original cost of printing machine. On 1st July, it was bought for 90,000, that is 80,000 plus 10,000 as the transportation and illustration. That year, the depreciation was charged only for 11 months, so 13,500. Now, book value is 76,500. What is shown in the working notes is nothing, children, but what we have done here in our account. Okay, 80,000, 10,000, depreciation 13,500, book value is 76,500. Then what happened? There was a machinery which was bought. Add original cost of the new printing machinery which was bought on 1st of Jan. Okay, the same they have kept here, 70,000. Now depreciation for 2012 to 2013, that is April to March, 15,300 on the first machine, 3,500 on the second machine, which I have explained it over here. So once you finish doing this, then you can show your working notes, or you can do vice versa, whichever is comfortable to you. So by end of the year, the book value of the machinery is 1,46,500. Depreciation was charged during that year. Book value. So this is the book value of the machinery for 2014. What we have done here, that very same thing, we have shown it in our working notes. Hope you all have understood. In case if you have any doubt, just leave a message on my WhatsApp number. I'll get back to you. Thank you for listening, dear students. Have a great day.